Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Cheryl, just for a moment, I'm seeing your GoToMeeting stuff and I don't see the slides.
Correct.
So we
Sorry
could
about
show that. It would be really nice, but it won't help anyone that's doing this. Anyway, good evening, everyone. Here it is, the 1st of December, the last month of the year. My name is Kevin Galogly. I'm a director in the DC Regional Chapter. And tonight we have 4 new presentations that are going on. We're going to be looking at Vertiv. We're looking at CVS. We're looking at Axon Enterprises and Decker's Outdoor. So this is a program that's being sponsored by the DC Regional Chapter and the Maryland Chapter. So welcome to all. The next thing up, as she's putting it there, is going to be our disclaimer. We're doing this for educational purposes. None of us are members of any professional investment groups or anything like that. We do this as volunteers. We do recommend that you do your own research and review. If we do talk about a particular stock, we'll try to tell you if we own it or not. And we will also, if we do show you any sites other than Better Investing, it's not an endorsement or promotion of those particular products. Cheryl's still trying to get her slides up. It looks like we may get there sooner or later. There we are. We're almost there.
Yep.
And this is what it gets when it comes together very quickly. Again, another indication that we are volunteers. So let's go to the 3rd page since we've done the disclaimer already.
Okay.
And the next thing is that, again, I see everyone, a lot of regulars here. But for those people that don't know, Better Investing is an investment education organization out of Michigan, just outside Detroit. They focus on long-term fundamental investing. And throughout this slide, you're going to see some things that have, or this slide deck, you're going to see things that are in a blue underline. That means that they are hyperlinks. So if you get the PDF that's in the handouts there and you click on it, it will take you exactly to those particular locations. And as I said earlier on the disclaimer, we are all volunteers from the Mid-Atlantic region. And we are doing this because we think this is a fun way to spend your social time. So let's go to our next slide. Here we are up on YouTube. Yes, someone wrote to me and it's just like, yeah, they got to be updated and get a few more in there. We're inching along with some of the subscribers, but we do ask that you go over there and like the videos, share the videos, and subscribe. That's how the algorithm works for YouTube, a product of Alphabet. But that sort of helps us. We're doing that. We'll give you this for free, but we ask you to do those 3 things. So please do that. Even if you're already subscribed, go ahead and like some of the videos. It just sort of helps with it. We organize these webinars up on the YouTube channel into chapters, is how YouTube calls it. And that's so that you can advance to just the stock you wanted to listen to. So you don't have to listen to all 4 of them. Just pick the one that interests you. Next slide. So again, we really haven't had too many people with troubleshooting. I may have to just modify this, but the more important thing is just that last green arrow going over to the right for the handouts. That's where you can get the handouts for the completed SSGs as well as for the slide deck. You can take that and share it with friends. We don't care. Please give credit to the work, but you can certainly share it with your club members, share it with people that are interested in joining your club, or just some people you like to talk stocks with, and compare our judgments with yours. Next slide. So why do we do this? Well, we just think that it's a great way to be able to find all the resources that are available as a BI member. And if you're not a BI member, that blue underline up there is a 90-day free trial that you can get. And we're doing these basically because we want to help beginners, people that are uncertain of their judgments, to be able to learn how to use our primary forms. These sometimes don't always come naturally to a lot of people. And so the best way, many of us believe, and I know I believe it, and that is to do, the more SSGs you do, the better you're going to get at it. It just takes a little bit of time. But if you're with a very supportive group of people that are in, say, the same club with you, or in your chapter, if you're not in a club per se, or if you're just part of an organization like this, you can certainly be a regular here. We'll let you do presentations. The whole idea of this is that we're doing a joint program with the Maryland and the DC regional chapter. We want to promote our model clubs, and we want to promote your club with Club Connect. So it's an opportunity to be part of the better investing community in the Mid-Atlantic region. You do not have to be a BI member. You do not have to live in Maryland, DC, or Virginia. And I see we have several people from other places around the country. Thank you and welcome. But that's the nature of what we're trying to do here. Next slide. So in just over an hour, we're going to look at 4 stocks. 2 that are the featured presentations from members, the member-only magazine BI, the stock to study, and the undervalued feature. And then the other 2 presentations will come from some way, shape, or form, either the BI website or the magazine. It can be your own personal experience because you know or use that product, or it could be from a myriad of the options for stock ideas that are part of our membership, like First Cut, online screening tools, ticker heat map. I think all 3 of them have some form of that. We also can have the Mid-Michigan Roundtable and the like. All of them are great places to find stock ideas. Next slide. So again, here's how you can be able to find stuff. Again, you don't have to be a BI member, but you can see the upcoming stock ideas. It can go to Home About Us at the news releases. If you look at the top of these, a lot of times where the blue banner is, you'll see the www.betterinvesting.org. That's where you can get there. And then again, go from Home and About Us to there. So these ideas of CVS and Vertiv, if I'm saying that right, was September 30th. So you can also see that they have stuff up for January and I think even for February too. Next slide. If you also want to make sure you get announcements, you can go, if you're a member, go where the red circle is to My Account. It will open up that screen capture on the left-hand side that says My Account, and you'll see that green circle where you have the email and product subscription information. If you click on that, it will open up the screen capture on the right, and that will show you where you can sign up for your local chapter news. That's where the arrow is pointing. And you can also sign up for the national stuff, the BI weekly newsletter, the one I have underlined in yellow, and do that. And then you have to hit save changes or they will not stick. But it's a way to be able to stay connected with our community. Next slide. So here's what the member-only weekly newsletter looks like. That a lot of events that we all like Ticker Talk or Stock Up, different stock ideas. It comes out around the close of business on Thursday. And again, if you signed up for it and you don't get it, check your spam filter. But here we are. We have things as we're getting to the end of the year, helping clubs close out their books for the year. That's the sort of orangish arrow. And then the blue one is to the latest stock up where they're going to be talking about making sense of GAAP earnings. So, and again, you don't have to be there when it happens. It will be recorded and put up on the BI website for members only. Next slide. We're also up on Facebook for both the DC Regional and Maryland chapter. Again, it can be shared with non-BI members and members alike. It's a great way if you're in a club and you want to be able to promote it, you can tag us and we'll tag you back so that you can be able to build interest on your particular club. We're always trying to find new ways to find members. That's one way to consider doing it. Next slide. So the Maryland chapter, they have a big event coming up this Saturday from 10 until 2 over at the Bowie Library, which is, for those people that don't know, Bowie is literally due east of Washington, D.C., maybe slightly a little bit north, but mostly due east. But at their library there, they're going to have a game day where they're going to be doing things like cash flow or Monopoly or Bull and Bear games. Great way to just socialize with others, so you may want to consider doing it. The cost, they may ask you for a little bit of money to help pay for the rentals of things there, but it's a great way to socialize with other like-minded folks. Next slide. Cheryl, to you.
The DC chapter puts on for 2 model investment clubs, one in Virginia called McNova, and the other one MCMC, which is the Model Investment Club of Maryland. Here is some of their events coming up in December, January, and even on into February. And please stay tuned for other things that we are putting on and further in next year.
Thank you very much. Ken, to you.
Okay. The Montgomery County Model Investment Club is started in 2017. We currently have 7 partners, or probably now 8 partners. We meet on the 3rd Wednesday of each month from 7 to 9. There's our link if you'd like to join us. So for our next meeting, education is to be determined, but our stock study will be Dexicom, and there is the point of contact information if you'd like to reach us.
Thank you. Cheryl, to you.
Okay, I'm a member of the Model Investment Club in Northern Virginia, otherwise known as McNova. We were started in 2008. We were one of the first, not the first maybe, but one of the beginning model clubs. Currently have 14 partners. They meet on the 3rd Tuesday of the month. So this month it will be December 16th, also from 7 to 9 p.m. online. And there's the link. Guests are free to come in and see how we make the sauce. And both the education and the stock study are to be determined at this point. But there is our point of contact email if you want to get in touch with us.
Armida.
Hello, good evening. I'd like to invite you to come join us at Pinnacle Group Investments. We currently have, I think it's 7 partners. We meet on the 2nd Saturday of every month, the next Saturday being December 13th. We usually meet from 10 to 1. Sometimes we go a little longer. Our education will be Atomic Habits by James Clear. We've probably been working on this book for about almost a year, almost done. And our stock to study will be Copart. You can reach me at my email at the bottom if you're interested in coming to join us, and let me know. Thank you.
And finally, we also have from the Maryland chapter, Happy Destiny Investment Club, started in 2001. There's a picture of us. We're 7 members. There's only 6 in that photo right there. But our 7th one is in the audience. So I see a Miriam. Hello. But we're on the 3rd Friday of each month. So we're going to be on December 19th. And it's all online. We have people everywhere from Richmond, Virginia to Baltimore, Maryland, and in between. We still haven't figured out what our education is, but our stock study is going to be Fortinet. So you can be able to join us for that. And the other thing is that we get together socially with some of the other clubs. In fact, we get together with Pinnacle and the Montgomery County Model Investment Club quarterly, just so that because we do so many things online, we like to have a potluck to be able to join us. So we're doing one actually this Saturday. If you are in the area, we are going to be meeting in Silver Spring. If you're inclined, you can be able to reach me at that point of contact there, digging.into.bi@gmail, and we can get you the information. You can come whether you're in a club or not in a club. If you hear of this and you're interested, let us know. We'll just ask you to bring something because it's potluck, nothing fancy. We just like to eat, show off our kids and grandkids, and also talk stocks. So if you like those things, go ahead. Yes.
I thought the holiday get-together was on the 13th, so not
it's
this
on the 13th. Yeah, but not this one. Yeah, it's a week. I'm sorry, you're right. It is the 13th. If I said something else, I am incorrect. But it is the 13th, so a week from this Saturday.
Yes.
Thank you for the correction. All right, Cheryl, to you.
There is a program now on Better Investing website called Club Connect. It is a program for BI members. BI clubs and people also on that free 90-day membership program that Kevin mentioned. So it's helping clubs that are looking for potential partners, as well as BI members that are looking for clubs to join. There's forms to fill out, and then you will get into the listing on the program. And please look into it if you are in either of those two categories.
And the other thing is that, you know, we call this digging into the BI. So we like to be able to look at the magazine. I know many of us wait until it shows up as a paper version in our mailbox. It came out pretty early this time, but you can also look at it over on the left-hand side on an app. You can also go to the website, sign in, and get it as an e-magazine. It always comes out earlier there so that you can be able to look at it on a computer, laptop, tablet, or your smartphone, any other type of electronic device. It's a great way to be able to fully embrace the 21st century and not do everything in paper. So there's a promotion for you. Let's go to the next slide. Because one of the things we do with this is that when we have these featured stocks, and you'll see this all the time, is that you can be able to get the analyst reports and the other information. If you see where that red arrow is over on the left-hand side, anytime there's a stock that's featured, this stock to study or undervalued feature, that the additional information, usually value aligned stuff, is going to be right there. So you can click on it and get it. To be able to get the BI magazine for mobile devices, it's a separate sign in, and that's where you have to use a green arrow to take a look at it. But you know, either way, you can receive the information on it. In the center, where you have the green spot that says View Magazine Issues, that's where you can look at the e-issue of the magazine. And if we click on that, we'll go to our next page. And I always try to find one interesting column. There were actually several that caught my eye. But the fact was that Betsy Wills, former president of the Rocky Mountain chapter, but still very active over there, she loves to look at small size companies. And so that she has in the Rocky Mountain chapter, they have a session where they look at smaller companies. And so this is a really good, if you are just learning how to use small stocks and why to be able to be involved in them. Many of us have a hard time looking at them because we don't trust our understanding of it as well as we do larger companies. She outlines a lot of those things in this article, but go ahead and take a look at this. I found, and Betsy's always a wonderful listen to if you're at any of the national events like BINC, and if she does speak at some of the other local chapters, this is a good article for you to take a look at. Next slide. And also on the towards the back of the magazine, they list all the upcoming events. Many of them are free and online, including this one here. We're highlighting the weekly Wednesday morning stock investment breakfast club. In fact, I see Stephen Emmerich's in the audience. Hello, Stephen. And they get together from 8 to 9 Central, so a little bit later here for us East Coasters. But they're very welcoming. Heart of Illinois, for those that don't know, is Central Illinois. And really a cool group of folks that are there. Please consider going there. They'll welcome you with open arms. Next slide. So we have two stocks that we're going to be looking at in core, Vertiv, which Armida is going to do, and then Ken's going to do Decker's Outdoors. And you can see where they got their ideas from, where they show up. And rather than me talking, let's just go to the next slide. And Armida, it's to you.
All right. Thanks, Kevin. The stock we're going to be discussing is Vertiv Holdings. Next slide, please. There we go. All right. We're looking at strategic overview and look at the growth outlook for this particular company. Next slide. The company is located in Westville, Ohio. It's in the industrial sector, and the sub-industry is electrical components and equipment. It's a large-sized company, and it has a health grade of C. This company is a global manufacturer and service provider of digital infrastructure technologies for data centers, telecom networks, and commercial industrial markets. Vertiv is a pure play on data center spending as it derives over 80% of its revenue from the end market. It's listed on the New York Stock Exchange since 2020, and so therefore it has a very brief history after being acquired by Platinum Equity from Emerson Electric in 2016, which is a company I'm sure many of you are familiar with. However, the company originated in the mid-1900s when computer rooms first required precision cooling solutions, and this company holds a leading share in thermal and power management products within data centers, has built out a long-standing customer base over its lifespan, and its equipment is critical to the safe and continuous operation of servers that run within data centers. It also does hardware sales, also offers a number of services to aid its customers, such as maintenance, remote monitoring, and technical training, and its cohort of field engineers, which works directly with customer sites, which is something that many of the customers value highly, because downtime in these data centers can be very costly. Next slide. We're going to be looking at Vertiv's vision, the financial outlook, the market trends, and the key priorities driving their growth and the leadership in digital infrastructure. Next slide. Let's talk about Vertiv's vision and market position. Next slide. Vertiv's core mission is to support the backbone of digital transformation, and they deliver infrastructure solutions that are scalable, efficient, and resilient, ensuring that their customers can meet evolving technology needs. Next slide. Vertiv is focused on operational excellence and capacity growth by enhancing operational efficiency and supply chain resilience. The company aims for improved productivity and on-time delivery through systematic programs. And as you can see, this company is very global in terms of its operations. It's got a very diverse portfolio in terms of power management, thermal management, IT systems, infrastructure solutions, and services. And also in terms of the market segment, you can see it's majority data center support, but also communications networks and commercial and industrial applications. But they're number one in power and switching distribution. They're number one in thermal management. They have over 4,000 field service engineers. There you go. They operate in over 130 plus countries. They have 23 factories and have over 30,000 employees globally. And in 2024, they have $7.8 billion in revenue. Next slide, please. Vertiv is also a leader that provides both critical services for digital infrastructure, like data centers, communication networks, and commercial industrial users. Next slide. Vertiv has a broad portfolio and deep expertise in AI computing and position themselves as preferred partners for leading technology companies. They collaborate with various companies to drive innovation and customer value. They also have a global, long-standing service and consulting capabilities using both data, predictive data, and AI solutions to provide implementation, lifecycle, and optimization services to their customers. Next slide. Let's talk about Vertiv's financial performance. Next slide. We're going to look at the revenue margin highlights from 2024 for Vertiv. As you can see, Vertiv's financial performance for 2024 was very strong, with significant revenue growth and improved margins. The performance has continued through 2025, as demonstrated in Q1 and Q3 results, which we'll look at on the next slide. The management feels that this performance reflects their disciplined execution and focus on high-value opportunities. What we're going to do here is look at the summary of both of the third quarter results. I can't see it on my slide, but I think up in the right-hand corner, on my screen rather, up in the right-hand corner, you'll see that each one of the colors represents the first four bars represent quarters, and the last few bars represent years. So you can see the metrics of revenue, operating profit, cash flow, and how they have increased year over year, and also quarter over quarter. And as you can see, the orange bars represents the third quarter, which we're getting ready to discuss right now. Is it the orange? I think it's orange. I can't see. But anyhow, third quarter highlights are that revenue was up 29% year over year. Adjusted operating profit was up 43% year over year. Adjusted earnings per share was up 63% year over year. And free cash flow was up 38% year over year. So they were able to maintain the momentum in terms of double-digit growth across all metrics. The profitability is scaling faster than revenue, and they have had very strong cash flow strength, whereby it continues to rise in line with profit, showing that they can support both reinvestment and balance sheet resilience. And also, they've raised the guidance for Q4 2025. They're expecting revenue to be up 20% for revenue, earnings per share 27%, and margin approximately 22.4%. Next slide. This slide shows Vertiv's growth story, enables you to see it's not just 2025, but they're also expecting 2026, which you can see on the right-hand side of the graph. They're expecting another year of double-digit expansion with both strong fundamentals and strategic investments, ensuring resilience against external headwinds. And also, it shows you that they're not just growing top-line revenue, they're also improving profitability, efficiency, and also positioning itself to sustain strength into 2026 and beyond. And so now we've looked at the financial trajectory. Now we're going to look at the strategic narrative in terms of what is the strategy that the company is talking about that enables to drive the company growth. Next slide. Next slide.
We have 5 minutes in case you needed that.
Let's talk about their core focus areas. Vertiv's strategy centers on financial discipline, customer-centric focus, and continuous innovation. They also foster a culture of operational excellence and high performance across all teams. Their leadership team is committed to execution, urgency, and continuous improvement. Next slide. What market trends and competitive advantages drives Vertiv's growth? The data market is expanding rapidly, fueled by AI and digitalization. Increasing infrastructure complexity also presents both challenges and opportunities for Vertiv solutions. Next slide. So in terms of their market trends and growth drivers, the global market is projected to grow approximately 20% compound annual growth from 2023 to 2028. And the key drivers that include AI deployment, digitalization, and increasing complexity in infrastructure requirements. Also, in terms of its competitive advantage in innovation, they boast a comprehensive portfolio and application expertise to support future-ready infrastructure, as well as current infrastructure. And also, they're positioned to lead in AI high-density computing, and they collaborate with major players like NVIDIA and I can't remember what the other one is. It'll come to me. Anyway, next slide, please. Now let's talk about operational excellence and service innovations. One of the things that Vertiv prides itself in is its operational excellence in terms of efficiency and AI-driven solutions, as well as service innovations. And these are examples of some of those. Next slide. Now let's look at the financial outlook for Vertiv Holdings. They're very confident in their long-term financial projections. Look too fast, but that's fine. That's fair. Okay. They're projecting organic growth from 12 to 14% compound annual growth from 2024 to 2029, exceeding market growth. And they expect operating margins to reach at least 25% by 2029 with strong free cash flow conversion. And looking at margin expansion, which they work very hard at. As you can see, they expect them to grow, as I said a little earlier, by 25% in 2029. And they talk about also strong free cash flow generation, as well as merger and acquisition strategy and future technology focus, whereby, because with M&A strategy, they focus on bolt-on acquisitions to enhance the digital infrastructure portfolio. And recently, they've recently purchased companies Powertrain and Coolterra that have strengthened their capabilities and exceeded performance expectations. Next slide. Look at the stock selection guide and see what trends there are. Next slide. Too far? There, one more. There you go. All right. In terms of trends, you can see for both sales, historical and post sales and earnings, they've been up and straight pretty much. In terms of forecasting sales, future sales and earnings, I found numbers in both Morningstar, CFRA, Value Line, and Better Investing Sentiment. And with those numbers, I came up with a 5-year estimate of 20 for sales, where the estimate for the past, I used 1, 2, 3, 4, 5 years, it was 16.5%. And for earnings trend, I used 20. And I can't see what the number is in the slide, but it's also in line with their growth. Looking at percent pre-tax profit on sales, you see it was increasing year over year somewhat. Percent return on equity, not quite as smooth as we'd like. You can see major dips in 2020 and 2022. Percent total debt, significant increase. However, leveling out after 2022. Percent debt to capital, as you can see, it increased significantly from 2019 to 2020, but it has decreased significantly since then. All right, next slide. Looking at the price projections, I used a high PE of sort of 64.7 and a low PE of 32.9 based on historical numbers. And it gave me a high forecast price of $426.40 and a low forecast price of $86.20. The current price is $199.30. This stock has quadrupled in the last 52 weeks. I think it was somewhere, the 52-week low was $53.60. The risk reward places in the hold, and it's at 2 to 1. And the compound total return using the forecast high PE is 60.5% with current yield of 0.1%. And what I did is also looked at the audit, which helped me assess the movements I made throughout the SSG to see if some of the decisions I made were good or I need to adjust them. But one of the things that the SSG was telling me is that we really only had 5 years of historical data for both sales growth and earnings growth. And some of those were not consistent nor rising year over year. Also, we had return on equity was quite low when the SG suggests that we're looking for somewhere around 15% when we're looking for the amount of growth that we would like to have. And Vertiv's is only 2.6%. And another thing, in terms of debt to capital, the company's debt capital was quite high at 56.4%. And for a IT company or IT or data digitalization company, I was concerned about whether or not this was high. And I can tell you that their debt to capital has been much higher in the past. And when I compared it to its competitors, it's still higher to its competitors. So that was one of the points of concern. In terms of my forecast, which I think is also important, of course, it was concerned about the high PE, but again, the PE for this company has been decreasing significantly. And also, in terms of the relative value, the high multiple earnings is much higher than what this company has been going for the past 5 years, but then we only have 5 years of data. And of course, you're not going to double your money in 5 years at this current price with an upside downside ratio of 2 to 1. Next slide, please. Conclusion. Okay. As you can see from the SWOT analysis, what we're looking at is version of what Vertiv is trying to do financially versus how it's positioning itself strategically to help you understand not only where the growth is coming from, but also what can accelerate it or derail it. And so understand that strengths and weaknesses, that's internal. Opportunities and threats, that's external. Growth is going to come from your strengths and your opportunities, and weaknesses, okay, and things that inhibit your growth are going to come from your weaknesses and your threats. And so what we do is we're going to tie both your strengths and opportunities to your revenue visibility, your margin expansion, and your cash flow growth. And then we're looking at weaknesses and threats in terms of any changes in those are going to show up in your margin volatility, your backlog conversion risk, and your leverage sensitivity. And your most sensitive metric is going to be revenue and operating margin, both of which are going to be heavily influenced by both AI demand and tariff offset. And I can tell you, when we go to questions, don't ask me about what some of these things are, because I haven't had a chance to look them up in terms of deep hyperscaler relationships, et cetera. All right. And what a brownfield upgrade for AI workloads are. All right. So next slide, please. So what we can see is that its growth has been robust, but it's not immune, okay, to those factors that may either accelerate or decelerate its growth. The upside case is that AI demand accelerates and the tariffs offset smoothly, and you get increased growth in Europe, Middle East, and Africa. Or the downside case is that the AI demand slows, the tariffs linger, and your growth in both, like I said, Europe, Middle East, and Africa remains weak. And so what our SSD showed us was that through the audit, you've got outliers in your data. The data is limited. You lack your increases in revenue and earnings per share. You have a low return on equity. It's overpriced. Your risk return is telling you your money is not going to double in 2 years, and you have a high debt to capital. Morningstar says it's a hold because it's overvalued with high uncertainty, with narrow moat, and expects business to support above valuation. Value Line says it's a hold because it's priced at $121.82, and it's currently $199. CFRA says it's a strong buy based upon their discounted cash flow calculations. So the SWOT analysis showed us that the company's at a pivotal inflection point because there's strong AI-driven demand and backlog growth, but the execution risk and competitive threats remain. But still well-positioned, to capitalize on generational AI infrastructure build-out, but its success hinges on flawless execution, the margin discipline, which is so very important, and staying ahead of the competition in cooling and power innovations. Thank you. Is there any questions?
Thank you, Armida. And before we go over to Ken, I just sort of wanted to give a heads up. Apparently, I misspoke when I talked about the game day for the Maryland chapter. It's actually not this Saturday. It's next Saturday. It's the 13th. So Somehow I got my Saturdays mixed up. Anyway, with that, Ken, why don't you tell us all about Deckers?
Hey, good evening, everyone. So tonight I'll be presenting Deckers Outdoors. Next slide, please. So this one I actually found through Manifest Investing. At the time I found it, it was ranking at the top of the footwear and accessories industry, as well as the one of the top stocks in the discretionary sector. Also found the quality and the PAR attractive. Next slide. You can also find it by using the Better Investing ticker heat map. If you look under consumer cyclicals, at the time I was looking at it, there were about 497 studies by BI members within the last 90 days. Next slide. So just kind of a corporate overview here. So in 1973, the corporation was founded by Doug Otto and Carl Lochter. Distribute niche footwear like innovative flip-flops and sandals. In 1975, the company formally incorporated in California. And then in 1985, River Guide Mark Thatcher brings telesandal concept to the company, leading to greater success. In 1995, they acquired the UGG brand. And then in 2003, the company changes its name from Deckers Outdoor Corporation to better reflect its expanding line of outdoor footwear and apparel. In 2011, they acquired the Sanuk brand. And then in 2012, they acquired the Hoka 1-1 brand. So it's a brand known for its cushion running shoes. Then in 2014, the company officially rebranded itself as Deckers Brands, though the corporate name remains the same. The company is also listed on the New York Stock Exchange. And if you had invested $10,000 5 years ago, it would be worth $20,085 today. So it has doubled in 5 years. Next slide. So just kind of an overview based, looking at some of the segments here. We can see that UGG and Hoka seem to dominate here, where UGG is about 51% of their sales in 2025, followed by Hoka with 45%. The other two brands bring in a modest 4% of their sales. And then looking at things from wholesale to direct to consumer, we can see that wholesale makes up 57% of their sales, whereas direct to consumer is about 43%. And then looking at things regionally, 64% of their sales in the United States and 36% are international. We've gotten, looking at the graphs at the bottom here, we have nice growth on revenue and earnings over the past 3 years. So the revenue was up 16% for 2025. Nice gross margin, a nice operating margin. Next slide. All right, so taking a look at the Hoka brand. That particular brand was up 24% in sales for 2025. You can see the various variations that they have there, and you can kind of see how the revenue has grown globally over the past 5 years. So what they see as building blocks for future growth are to increase their brand awareness through expanded marketing distribution, to market share gains in unpenetrated geographies, and to broaden consumer base through extended footwear and apparel offerings. Next slide. And then looking at the UGG brand, they were up 13% in 2025. Again, at the top, you can see the various variations of this particular brand and how it's grown over the past 5 years with the graph underneath. And so they see their building blocks for future growth here as expanding the product versatility, um, also through market share gains in unpenetrated geographies, and also through increased brand adoption from male consumers to represent a greater proportion of the revenue. Next slide. So taking a look at the value line, we can see that they, at the time of this report, on October 17th, they were trading at a 16 PE, which they expect to expand to a 20 PE going 3 to 5 years out. They are undervalued as they're currently priced below the cash flow line. And then, looking at an 18-month target, they're looking at roughly a 25% return, and then a 3 to 5 year annual total return in the range of 10 to 21%. Part of the commentary, they believe the shares look attractive at the current price, and they believe there's good performance going forward. Next slide. Taking a look at what I was able to find through CFRA, shows up as a strong buy with a 12-month price target of $159. Sub-industry outlook for the footwear sub-industry is positive. Then in the commentary in the analyst risk assessment, they factored Beck's top-tier margin profile, high return on invested capital, favorable product mix, catered to indoor comfort through the UGG brand and outdoor recreation through the Hoka brand, and their strong balance sheet, which positions the company to navigate through tough macroeconomic environment and uncertainty regarding consumer spending. Next slide. So looking at the bull and bear case as presented by Morningstar, the company's experienced tremendous growth over the past few years. Popularity of the brand allows for high price sell-through and profit margins. A successful restructuring effort has brought improving sales and profitability for UGG, which they think will hold its position as a premium brand with strong margins. Both Hoka and UGG have opportunities for greater distributions and geographic expansion and extensions into new categories. On the bear side of things, Hoka and UGG are known for specific styles of footwear that could fall out of favor with consumers or be adversely affected by knockoffs given the limited barriers to entry in the space. Also, Teva and Anu generate immaterial sales and profit. The effort and expense to put into these brands could hurt financial results and distract management. And then finally, as the company relies heavily on imports to the U.S., Deckers is subject to high tariffs that could reduce margins and sales. Next slide. All right, so when I did the review of competitors here, I tried to look at companies that were of similar size to Deckers. Deckers is a small company, so the best I can do in terms of comparison was to look at medium-sized companies, and I kind of found the companies through their 10K in terms of how I found their competitors was through their 10K. So looking at pre-tax profit, we can see that they seem to definitely outperform the peer average here, as well as their competitors of what I could find of similar size. And then on return on equity, it looks like Crocs kind of wins it here with an average 5-year return on equity of 104%. But Deckers comes in second and certainly outperforms the peer average here, which I think is good. And then finally, looking at debt to equity, their 5-year average is at 11.9%, which is definitely well below the peer average and well below their medium-sized competitors here. Next slide. So in doing the SSG, I use 10% as my sales growth estimate. This company was also presented during the Manifest Roundtable in June, and I believe Ann Manning used a estimate of 10% for her judgment, so I kind of went along with that. Next slide. And then for the earnings growth judgment, I used 10%, which was also Ann's judgment when she made her presentation in June. Next slide. And then looking at pre-tax profit on sales, as I had shown you before, they seem to have very good numbers. You know, they're outperforming the 24 core numbers are outperforming their 5-year averages for pre-tax profit and return on equity. And you know, their debt is you know, well below their 5-year average. Next slide. I used 21.1 for the high PE, which is the 5-year average PE, and I used 11.7 as my low PE. Which is the trailing month, 12 trailing months low PE. And then my low price is $54.40, which is the average of the average low of the last 5 years. Next slide. So it falls into a buy as the time I looked at this. I think it, you know, still priced close to that. So that's a upside downside ratio of 5.5 to 1. Next slide. And it's offering a return of around 23%. Next slide. So in terms of the drivers of shareholder value here, long term, they're looking to build their major brands that are doing quite well for them, Hoka and UGG. They want to expand their direct consumer business, also expand their footprint internationally, also while maintaining the top tiers of profitability overall. And then they want to evolve Deckers to meet the changing marketplace by working with the omni-channel distribution, leading with direct-to-consumer while allocating and segmenting products through strategic wholesale partners. Supply chain logistics, they want to remain agile and maintain supply chain and inventory planning discipline. They also want to invest behind key talent to help scale the organization globally. And they are also investing in tools and infrastructure to enhance digital capabilities. And then finally, they want to drive shareholder value by generating healthy profitability and shareholder returns, and which they'll do through controlling fixed costs while increasing variable spend, achieving compelling revenue growth with high caliber operating margins, outstanding authorization increase to $2.5 billion, which is a little over 10% of their market cap. So they're repurchasing shares. And then their balance sheet, they have a healthy cash balance and credit facility to provide flexibility to return value to shareholders. Next slide. So DEC is it's a medium-sized company. Well, it's well managed. I forgot to change one of the items there, but its DEC is undervalued. It's trading below its 5-year average. It is a buy with a 5.5 to 1 upside downside ratio, and actually, and a 23% return. and I believe it's a worthy candidate for your consideration. Next slide. When I presented this to my club, I have any questions slide, but we'll save that for the end. Next slide.
Thank you very much, Ken. Appreciate it. Always good. So now we're going to have two presentations that are going to be done in SSG Plus. I'm going to do the undervalued feature, CVS Health, and then Ed Rodriguez is going to finish up with Axon Enterprise. So I see I have one thing listed for Ed saying small company discovery. That's incorrect. It's actually, he'll talk about it there, but I didn't edit this as well as I should have. Let's go to the next slide and let's keep going. So I'm going to be able to talk to you about CVS Health Corporation. They're the undervalued feature this month. They're also a first cut that was done in April. They're also in the top 100 of commonly held stocks here. So it's a well-known community. It's well-known inside our community. Let's go to the next slide. So I always like to, when I get one of the featured stocks, just to be able to take a look at the magazine, because in there they usually have a line or two, a paragraph or two from, what the Security and Review Committee thought of this particular company. It gives you an insight into what their thought process is. And, when you look at the header part, they've done some reshuffling. They've gone through 3 different chiefs in 4 years. They have a business that they acquired that went into bankruptcy. You're like, what, huh? And if you look at what they say in the members stump, the second quote I have on the lower left is that, they think of by cutting back on Medicare Advantage and the individual exchange offerings because of the rising costs and cutting into their margins, if they focus instead on doing more business with private insurers, it's going to help boost things all along. So that's one of the key drivers. And as last month, when I was talking about Robert Half, we had Mark Robertson here, who used to be on the Security and Review Committee. And he said some of these undervalued features, yes, they don't always necessarily look really good on the SSG, but they're anticipating that some change is going to be going on. And they sort of have a feel for what's going, that there's some positive influence. So when you see one of these and they have a really kind of crummy SSG visual analysis, and this one does, is that you have to wonder, okay, what is it that these people that are experienced are taking a look at to see what's going on? Let's go to the next slide. So if you see that, once again, you see this visual analysis and you're like, why are we doing this? You feel like you're in the back seat, as I said last month with Robert Half, like you're in the back seat getting the secondhand smoke from Cheech and Chong. And you're wondering, what the heck were people thinking about it? Now, at the same time, since this was presented as an idea in September, it's gone up about $3.50, $4. And to get their 15% return from the date of selection, they only have to get up to about $82, $83, and they will make it. And it's also up 76% since the beginning of the year. You can also see where the current price is up near the top of the 52-week price bar. But again, looking at these, a lot of the drop in this current year is just because of some of the bankruptcy on that one company and some other issues there. But my God, even if you take that out, it still is sort of trending in an area that I have to wonder, what the heck's going on? So let's go to the next slide. This is what you really call a turnaround company. And, to be able to do something like this you have to believe it has a potential for better performance, which is essentially what Mark was talking about with the undervalued features. And you really have to check to make sure that they have enough financial strength or health to get out of it. So you can look at, some of our metrics, whether you're using the manifest quality ranking or the core score. You can look on the SSG. You can see where they have the Morningstar Financial Health grade. All of these things that can be able to help you sort of double check on debt to see what's going on. Because, are they trying to make changes? There's this new leadership team. The fact that they've gone through 3 CEOs in such a short amount of time, I would want to sit there and sit back and go, prove it to me before I start putting some money down on this one. And if you're a newcomer, I would clearly stay away from something like this. So let's just continue on. And so here's sort of a background. It's in the S&P 500. It's actually in what they have a subgroup called the S&P 100, which are the top 100 stocks, and they really sort of drive things. Again, it's super large sales size. It's almost 400 billion out of Woonsocket, Rhode Island. Um, the financial health grade B is actually very good. It's in the top 30% of it. If you look at this core score isn't really too bad at 212. Quality, so. But the thing is that the sales growth, it's just hard for a huge company like this to grow. Its financial strength is a B++, which is just about average, maybe slightly above average. Nothing spectacular there. But overall, I can see where some of the analysts are talking about how they have a good balance sheet and how they're generating a lot of cash flow. They are, but the fact is that they made so many acquisitions and keep turning things around, trying to rejigger things to take a look at it. And you look at that visual analysis and you're like, I'm not certain I can see where it's really going to grow. So let's go to the next slide. And I like to sometimes look at this second page of CFRA. They basically are going to the SEC, looking at what CVS wrote and summarizing it into one page. And you can get a really good idea of what they're doing. So they have the drugstore chains, they have the pharmacy benefit managers, and health insurers. That's basically the three components that they have. The drugstore chain is, as we know, the stuff there, that's about 125 billion in annual sales, but it has such a low volume in terms of the money it makes from that. When you're looking at the pharmacy benefits, that's they do pretty well with that. They have, I think it's like about 160, 170 billion a year on that. But where they also make some of their bigger money is with the healthcare benefits, basically the old Aetna part. And they're about 125 billion, but they tend to make a lot more in terms of their profit from there. And that's where they have 26 million people subscribed with it. So that's sort of what they're trying to do, is sort of be this sort of one size fits all for all healthcare. And I'm not certain that they've really pulled it off, because look at those numbers. So let's go to the next slide. So I always like to look to see what the growth drivers are. And, I won't read you everything. Go ahead and download these slides. But again, they think that they can grow because they're going to get increased prescription volume. That's good. Favorable drug mix. That means that they're going to make more money on those types of things. It may not necessarily benefit the consumer, or they're actually getting it from people that are insured, and they're getting a higher percentage from the people that they're dealing with. They're looking to expand and integrate. They're trying to be sort of holistic in what they're doing. But again, I'm just looking at a lot of these things, and I'm not finding anything that sort of wows me into going, oh my God, this is really good, and to go with it. And I realize an undervalued feature is going to have a few, warts and stuff like this, but this may be more than just a few warts. Let's go to the next slide. So again, I also like to look to see where they look at their primary target market. They got the retail customers, older adults. Again, they're the ones that have the greater need for prescriptions, as well as for health coverage and stuff. They're trying to be able to sit there and get employers to be able to use their Aetna subsidiary and the like, in trying to tailor health plans that will benefit from Medicaid and Medicare. And of course, that's a constant battle that, as long as I've been involved in better investing, 25 years, that's been a sort of standard question of what's going on with these healthcare companies because of Medicare and Medicaid. So overall, I'm not seeing, over those 2 pages, I'm not really seeing anything that sort of jumps out at me as like, wow, I really need to be in this industry, or I can see where this turnaround is going to continue. Let's go to the next slide. So I, like Ken, I looked at Manifest, and again, the numbers aren't too bad, but it's not showing up as one of the top ones in the healthcare plans. It's not top in healthcare. Healthcare plans is the industry. Healthcare is a sector. But again, it's hard for a company like this to grow at large numbers. It just can't. And the numbers, while they look pretty good, they're fine. If you want this because it has a steady income stream, yeah, you could do that. I mean, the dividend yield, 4.8 is pretty darn good. If you've held this for a long period of time, like 15, 20 years, you may say, look, I got a lot of money from this and I'm getting more in dividends than what I paid for it. That's a plus for you. Enjoy it. But the fact is that at this particular point, I think trying to go forward with it, I have a hard time trying to figure out why we'd want to be involved in this. Let's go to the next slide. So I sometimes will look at the secondary metrics. Here I took them on out. You can see the green, the light green in the middle, that's dividend. That's the dividend growth. That looks pretty good. You look at the red, that's a total debt. You can see that big jump from 18 to 19, that's Aetna being acquired. And then it's sort of balanced out there. And then sometimes when they make acquisitions, the other thing they do is they'll actually dilute shares. And again, you can see between 18 and 19, they diluted shares. Again, mostly due to the Aetna acquisition. But they brought it down a little bit, but they're not drawing down shares. They're not, diluting. They're not buying back shares. They're giving you a nice dividend, but there's nothing spectacular that makes me want to jump out and go, yeah, I want to be a part of this. Next slide. So my conclusion is that, you may, I don't agree with the prospects that they have for CVS. In my judgments, I try to look pretty positive. I try to be sort of look at the sunny side of life, but you can see my SSG there, but I have it as a whole. I really can't figure out what CVS really wants to be. I think it's so big and has so many things, and they've tried to be all things, all people in the healthcare field, and I'm not really certain that they know what they're doing. Caremark, their prescription benefits is done well. Aetna, it's okay, fine, but Aetna wasn't a spectacular stock in the previous when it was an independent company. And I just think overall, I just don't think that there's enough here to get really excited about. So I'm actually telling you, I think you ought to pass on this particular one. But you can see my SSG. I think I was trying to be fair and reasonable what I was looking at. But my instinct would have been to just sort of pass on this even at the get-go. Next slide. So with that, let's go to our last, but certainly not least, Ed Rodriguez, and he has something more interesting than CVS to talk about.
Thanks, Kevin. My name is Ed Rodriguez. I'm going to be presenting Axon Enterprise. Next slide. I basically founded via a search. You can see the parameters there to the left, emphasis on high numbers for earnings and growth. It's a medium-sized company. So this is where you can find it. Now, most of you probably have not heard of Axon. You probably would maybe recognize it by its earlier name and its signature product when the company started. Next slide, please. And that's Taser. Axon's origins is basically in the production and sale of tasers to principally law enforcement agencies. Next slide. Let's talk a little bit about its evolution over the years. It's been around for about 30 years. Back then, it kind of started by having that basic product, the taser. I show a picture of it there. It was demoed out in Sweden. Even from the beginning, this company had a vision to protect life with less lethal devices. It's held true to that main focus. In 2008, they introduced the body cam. Anyone that sees these videos with the police being involved, I don't know if you've noticed, but in the upper right-hand corner, you'll see Axon there prominently displayed. Over the last decade, what it has done is it's taken itself from being body camera and taser manufacturer into a more comprehensive public safety company. And with that, basically constructing an ecosystem. Right now, today it's capitalized at 43 billion. It is about 4,000 employees, and it has a growing presence outside of the United States. So let's now find out what exactly does Axon do in a little bit more detail. Next slide, please. So on this slide, you'll see that Axon basically has two major divisions. That's how they report their earnings and sales and their activities. The first one is basically hardware. That's the connected devices sector of their business. This is where they have tasers. They have body cams. They also have stuff that goes inside a police officer cars, namely just regular body, cameras for the car, as well as plate scanners. And then, interestingly enough, something that's not widely known, I think, is the growing emphasis on drones and robotic security. We'll talk a little bit more about that being one of their potential catalysts for significant growth going forward. On the bottom here, we have software services. Basically, evidence is the software that's tied to the cameras predominantly. So when video is taken, evidence will manage it. It puts it up on the cloud. That's a subscriber-based service. They also offer the response and Fucus, which is like to basically provide real-time support for operations. You'll find this generally at 911 centers. And on the bottom right, you'll see one of their recent major investments over the last few years has been in integrating AI in order to enhance decision-making and boost the efficiency of staff. Next slide, please. So we talked about the products. Let's talk about the value-added proposition and their strategy. Here, there's a lot on this slide, and I want you to focus in on 3 points. The first one is down towards the bottom middle, and that is the creation of an ecosystem. Basically, their strategy in recent years and going forward is to basically provide a one-shop integrated product offering. They have 3 major focuses. A little bit of trivia there. Their logo is actually intended to kind of represent like the human neurons, so hence the play on Axon and the shape of their icon there. The second thing I want to point out is the acquisitions. This has been a major activity of theirs over the last, say, 5 years. There's a number of companies listed there. I won't go through each of them. If later on you have questions about any one of them, let me know. But each of these acquisitions, some of them kind of costly, are intended to kind of fit within this ecosystem to support this integrated view of services in support of public service. The third thing I want to point out is the various partnerships that they've formed with different organizations. One thing I forgot to mention is a lot of these acquisitions that they made, these are small early stage companies. So they didn't buy these companies to get a burst of revenue. They got them in their early infancy. They are working hard to integrate them in. So sometimes people will acquire companies and those companies will provide immediate bottom line contributions. In this instance, this is not the case. So a little bit of patience is required, but along with that might be a little bit of risk in terms of whether or not the integration will work. The other thing over by the number 3 is analyze and report. These tools that are shown in the purple circles are really tools intended to make the human more efficient and better performing at their job. So now we've taken a look at their good product line and their coherent strategy. What does the prospective market look like? Next slide, please. So here, and so basically their total addressable, there's 3 things I want to focus in on. Their total addressable market here is pretty large. It's 159 billion. in the rest of the slide, you see it's broken down into two areas but in two different ways. One is by end customer, the second one is by product area. In the area of the end customer, I want to note that right now their penetration for state and local enforcement is under 15%. So again, I look for instances where there is good opportunities to expand your market with your hopefully very attractive and a very attractive product line. The third thing I want to note is that there's a pretty huge international government market there, and that's been substantially untapped. Hence the emphasis in terms of having folks in other countries and doing the marketing and sales and hopefully opening up those markets. Number 4 in the lower left-hand corner is the areas circled in the red triangle are areas in the TAM where they are the services that Axon sells are basically subscription-based types of services. Subscription-based services are really attractive from a business perspective in that they give you recurring revenue, and they are also allow you to have stable earnings and not have massive fluctuations when people are not on a subscription. Next slide. So now let's take a look about how they've been performing. Here you'll see the text I'm generally going to go through, but again, a reminder that this is a pretty large TAM, total addressable market that we're dealing with. Number 2, they've captured a pretty small percentage of that. 3, it's emphasizing what I just mentioned is that the power and stability of a subscription-based business is pretty attractive. And right now, Axon, 95% of its revenue is tied to customers that are on a subscription plan. Lastly, and this is an interesting statistic that you don't hear too much about, net revenue retention. You would think that a number like that might only go up to 100%. It's above 100% because what they do is that they not only retain their existing customers, but they upsell them with additional services. This is a pretty powerful paradigm. Next slide. So what do the analysts think? Morningstar generally is pretty negative on them. You can see here they've given them a 2-star rating. And by their metrics, it's trading at a 14% premium. They do note, in fairness, that they have a high uncertainty associated with their evaluation of Axon. So that number is not that specific or may not be that accurate or precise. They note that lack of profitability and their evaluation metrics are a little bit of a sign of concern. I will note that they do give it right now a narrow moat, but it is very close to having a wide moat. This is a very important attribute for businesses if they are going to retain their customers and have good operating margins. Next slide. So what does value line?
2 minutes.
Thank you. 2 minutes?
Correct.
Okay, what? No, go back, please. So Value Line is a little bit more optimistic in that they're focused in on, hey, there are clear avenues for growth. They do, however, kind of make the point of it's not a very timely stock. And by their definition, it has a low probability of beating the market over the next 6 to 12 months. They think it has good prospects, but you may want to wait for a better entry point. Next slide, please. Another way, okay. So these numbers are what I use for the SSG Plus. In general, they're in line with the numbers that are defaulted within the tool. I was a little conservative in both sales, EPS, high PE, and then the low price was picked based on just I like to use technical support levels for the low price. And that support level goes back to October of last year. That should have been October of 24. Next slide. So when we take a look at the main slide, you look at this and the first impression will probably be, boy, this is pretty hideous. What happened between 19, 20, and 21? So let's take a little bit deeper look at this. Next slide. So excluding these, there are 3 points I want to make on this slide. One is that there was a confluence of multiple factors that hit this company during that time frame. I've listed them all there. As a side note, I want to thank Grok and Google Gemini for assisting me in identifying these various things. If you don't use these tools to help you with some questions and analysis, you're missing out on a lot. So I won't go through each of these. You can go through them, but the interesting point that was made was that stock-based compensation expenses, which I listed first, was a pretty significant jump between, I think it was 20 and 21. So you'll see later that continues to be a source of concern from my end. The second thing I want to point out is that the tool does allow you to take a look at analyst estimates right here. They are estimating a dip and then pretty significant growth up. Now, this is only one analyst, so take it for what it's worth. But I thought it was an interesting thing in that it validates generally my impression of the prospects for this stock. Number 3 up there is, boy, that's an awfully straight, beautiful line as far as sales. That's it for this slide. Next slide, please. So I don't know if you noticed on the previous slide, there was a red line, and that was debt. And you can see here in tabular form that between 21 and 22, the debt to capital went from 0 to 35.9. That concerned me a lot. I wanted to understand what that involved. Basically, the company had a paradigm shift. Up until that point, they kind of funded their internal R&D and their operations with their internal cash flow. Given the rates that were available, they basically did their first issuance of debt. It was $690 million. It was at a very cheap price. They actually took some measures to hedge against the dilution of stock in the event that the notes get converted over to stock, which I thought was a pretty good management move. The bottom line is that they viewed at that point in time that they wanted to capitalize on their business momentum. They continue to grow, make inroads with different customers. They thought this was the right thing to do at that point. On the right side, I make a note that 0 to 36 is a lot, but it actually falls within a reasonable range for a technology company. Next slide, please.
1 minute, Ed, 1 minute.
So another way to evaluate Axon, and by the way, I did this back in February with Palantir, for software as a service companies that are young and growing quick, there's a measure that can be used called the Rule of 40. When you apply this to Axon, you will see that their score is 55. Again, it's not the classic kind of metrics that we rely on in better investing, but it is something that is used by other folks to evaluate companies when they're in their early stages of growth. Next slide. Okay, so when you crank all the numbers together, you will see that at its current price, it is a little bit below the threshold of it is below $550.70, so it is currently a buy, and it has a 3.9 to 1 upside downside ratio. Next slide, please. So risks and opportunities. So the PE is really high. A lot of these high growth companies are like that. It's really more of a reflection of prospective growth, and that out of growth you'll get earnings, and out of earnings you'll get profits. However, I think the biggest risk that they currently have is getting their stock-based compensation under control. It has been and continues to be a pretty significant ongoing expense. On the plus side, I think this is more of a catalyst-driven type of company. And next year, they're introducing a body cam product that's intended for the enterprise customer. It's targeting companies that want to provide some sense of safety to their employees, as well as hopefully be a deterrent for what we all know is a pretty significant amount of retail theft that goes on. The other thing is, we talked about the drones early on in this presentation. So the drones are not just a drone to help as a first responder. So, they show up when the police needs them to show up at a certain location to assist, to monitor what's going on. But another offering that's part of that drone offering is counter drone, which is to basically defend against drone threats. The upcoming FIFA World Cup in the United States and maybe other events internationally offer a potential market for this offering that could be a pretty significant boost to their sales and earnings. And lastly, traction in the international market. Axon owns really the state and local market for cameras and for public safety, making that providing that proposition, that value-added proposition overseas is what they're working on and making some inroads in that area. Next slide. It's a medium-sized company. It's fast-growing. It is borderline profitable. Again, they are spending a lot of money on these investments, on these acquisitions and new products. It's well-managed. I think has a great strategic vision and a committed client base with a high retention and a large number. They've made these strategic bets, but frankly, they're unproven. We don't know if they're going to be successful in selling those new products, but they are well aligned with their mission to protect life. It is a buy up to $550. It could be a buy now, but I would propose that maybe potential buyers, monitor over the next few quarters to see if these bets come to fruition and we see some earnings and profit acceleration, or maybe some key news might be a catalyst for significant stock price appreciation. Next slide. That's my presentation. Thank you.
So now we're going to do a recap, and I can see already with the yellow highlight, as I didn't complete that, Deckers, I think, was June of 2025. But we'll go through and have all four of our presenters sort of talk a little bit about where they put this on the T. Rowe Price life cycle. So let's go to the next slide. And why don't we start with you, Armida? And you said you sort of felt this was sort of in that explosive growth, Vertiv?
You're muted.
Armida, go ahead and unmute yourself.
Thank you. I was saying that the reason why I think it's an explosive growth is because of the rate of growth that it's been occurring for this particularly large company for the last 5 years. And if the management is able to continue to grow revenue with the number of data centers that are needing to be built, and they have something like a $6 billion backlog, and they're able to continue to grow margins, I think continue to see a lot of explosive growth out of the company.
Okay, thank you very much. Ken, tell us why you have that location for Deckers.
Yeah, it certainly didn't fit mature. I don't think it's a speculative company, so it just kind of felt right in the middle.
Anything else you want to add, or is that good enough?
That's good enough for me.
All right. And I've already told you why I'm not a big fan of CVS. I tried to look at it. I think, if you're looking for an income stream in retirement and stuff, I think this thing may hold out for you and you'll do okay. You're getting 4 or 5% on the yield. And if you've held it for a long time and it has some growth, you'll get even a little bit more. But overall, I don't think it's really where we, again, undervalued features can have a few hiccups. This one, I think, has been permanently hiccuping for about 15 years, in my opinion. And back to you, Ed, for Axon.
So even though Axon and its predecessor company, Taser International, have been around for 30 years, I think you see a tremendous amount of investment into the business with new product offerings across a whole spectrum, highly focused. I think they are very ripe for some very explosive growth over the next few years. Again, assuming that their bets are going to pay off, and nothing's a certainty, but I think it's a pretty good story. Thanks.
Okay, let's go to our next slide, Cheryl. And this one, we're asking you to vote not so much which one you want to buy, but which one interests you enough that you want to do further research on your own. We're not advocating that you buy a particular one. You can see our SSGs, but go ahead and release a poll and let everyone see what's going on. It's free. Hopefully, did I muck something up? There we go. Okay, good. Anyway, there are the choices, and go ahead and start voting. Let's see. It looks like the thing closed. I think we must have had to open and close it. Is there a way to? Yeah, it's just showing the results. I think. Well, unless we quickly create a new poll, Cheryl, why don't we just have people put in their chat which one they like, and we'll just sort of eyeball it. Sorry about that. This shows you again, we are not professionals. There's a list of them. Let me look in the audience and see what people are. Go ahead and just use the question box or the chat and put in your idea for what you like. Sorry about this, folks. Somehow we ended up closing our own poll before we even got you a chance to vote. So yeah, just use, like I said, I haven't seen anyone jump in on it yet, but go ahead and write in the question to the chat. Go ahead and just type in the ticker symbol for the one that you like. I'm watching it. Maybe I'm not seeing it, but I don't see anyone putting anything in. Oh, here we go. There they are. They're all the way down at the bottom. Okay. I'm really shocked. No one is taking CVS. Well, this looks like it's going on a runaway. We'll go a little bit more. I don't know how many people are still left. You still have a really good attendance. Oh, here they are. Here's some more coming in. Okay. Why don't we sort of end it here? But it looks like I'm just eyeballing this. It's pretty close, but I think Deckers may be winning out, although we had a lot of people kind of split between Vertex and Axon. I may have to sit there and collect all these and double check to make sure, because for a minute I thought it was all Deckers, and now I'm looking at some of these others and it's pretty darn close. Anyway, with that, sorry about that, folks. We'll try to get better next time. Let's go to the next stuff. And Kent, if you can take a look and see, we've had some questions coming on in, and we can you can throw those out.
I will do my best here. Let's see. All right, there we go. So Vertiv has a comment, a great presentation. The quick question would be, what's the biggest risk that Vertiv needs to address now to enjoy profitable growth in the next 3 to 5 years? So Armida, any follow-on or any answers to that question? And then a follow-on question. Well, I got a follow-on question after you're done with that one.
Well, the biggest would be the opening the building of data centers, because that's where the majority of their revenue comes from. And so if there's a slowdown in the need for data centers, then it's going to affect their revenue growth significantly.
Very good. And the one question was about how you decided to which data to eliminate on the front side of the SSG to consider in your analysis, and I guess that's the question that's here.
That for me?
Yes. Sorry, Amita. Yeah, that's for you. That's on Vertiv as well.
Let me look at my SSG here. What point are we talking about? Are we talking about in terms of sales or earnings per share?
Earnings per shares. Earnings per share.
Okay. What was very difficult, matter of fact, I ended up only having 3 data points for historical earnings per share, and that was 2021, 2023, and 2024. And because I'm trying to remember what the justification was, because it ended up giving me like a 61.4% growth rate. Because as you can see, they can't see, but 2018 and 2019 and 2022 were quite low. All right, which
you were going from negative numbers to all of a sudden positive numbers. Exactly. And that is what caused the large increase in the change of percentage change.
Yeah.
Okay.
Does that help? I mean, because in 2017 you had 0. 2018.
Michelle, that's a question that you had. Did you find the answer?
Let me see if I can find Vertiv here. Hold on.
There we go.
Oop.
Yeah, you can confirm or deny whether that answered your question or not, and then we'll move on to the question about Decker. Hearing nothing. Regarding Decker, Ken, why did you choose 10? Okay, the question is, why did you choose 10% when it says 50% on the, or 50 on the SSG? And I'm not quite sure I understand that question, but maybe you have a better handle on that.
Okay, so the question is, why did I choose 10% when it says 50% on the SSG?
Well, that's what the question is here. I'm not quite sure if I understand what that's about. So I was hoping maybe you could figure that out.
Okay, I'm just going to take a quick look at my SSG again. But okay, 10% was the judgment that Ann Manning made when she presented it in June. So I just kind of went along with her judgments. Okay. But I mean, I'll take a look at the SSG again real quick here to see where this 50% is coming from.
Yeah, I don't quite get that. It might have been a PE of 50 instead. And that's all of the questions we have, Kevin.
I did see a couple towards the bottom. I finally did a tally of all the votes, and it literally was a dead heat between Vertiv, Axon, and Deckers. I think Vertiv was 1 vote more than all the others, but they were in a dead heat. But towards the end, we had one person who said he's passing on all of them, but Lee was asking, Ed, what are the 2 research sources that you recommended?
Yeah, what I ended up using was almost as a default, when you pull up Google, I put in expansive questions and it automatically invokes their latest oh God, what's the name of their main LLL tool? Oh,
It's not Gemini, is it?
yeah, it is. Thank you. That's exactly it. So it uses Gemini 2.5. If you really push it and ask it a little bit more complex question, it will give you a Gemini 3.0 answer. And then the other tool that I use, which frankly it was actually pretty significantly better than Google. I was actually surprised. Was the X/Twitter tool Grok. It provided a lot more detail, more numbers, and justification for its opinion, and actually was a little bit more detailed than the Google. So again, if you're doing this stuff on your own, I know for myself, I will not ever go forward without using those tools, because when you're in the middle of something, going, so why did earnings drop that much? And you give it the question, and it will refer to the 10Ks, it will refer to news articles. It's impressive.
Very good. Cheryl, this next question.
Back to that previous question. Okay, I'm looking at the SSG and I see where the historical earnings were at 50%. The historical earnings were at 50%. I would not select 50% as my judgment, because that's just not a sustainable rate of growth. I believe at some point growth will begin to slow, even though companies might have that type of growth initially, but over time you'll find that growth will begin to slow, and so you have to select something that's more reasonable. Hope that helps.
Sure.
Yeah,
Cheryl, if you can take away
that was really helpful.
the poll, and someone wants us to go to, Sophia wants us to go to slide 35. I think this is for Vertiv. And Sophia's asking Armida, what was the source of the charts on slides 35 and 36? If you can put up our presentation again and go to that location.
Were they?
I've got them up on the screen.
I'm not seeing it. Is anyone else seeing the presentation? I'm just seeing the cover part that
Right,
says.
digging into VI.
Yeah, that's what I see.
Wow, I don't know.
It's the financial metrics comparison of revenue, adjusted profit, and free cash flow.
Yeah, but let's see if Cheryl can just sort of.
And that's page 35, and then slide.
The source, I'll tell you, the source of the data was was actually from Vertiv, their reports, and I had it create those graphs from the data that it provided.
Awesome.
Here, let me do this. Let me see if I take over.
Okay.
And show my screen.
Yeah.
Can you guys see it now?
I apologize. My computer has developed a mind of its own. I think it's AI.
It could be. So are you guys seeing slide 35 here?
Yeah.
Yes.
Okay. Yeah, so yeah, this is what Sophia was asking, was on 35 and 36.
Yeah, that data actually came from the third quarter reporting. Okay.
And same with this on slide 36?
Yes.
Okay. If there's anything you want to follow up with, Sophia, just put a question in there. Great to see that you're here. We had a really nice turnout here today. I know people are leaving. We've gone kind of long here, but very impressed with the turnout and people from all over. So let's see if we have any other questions.
Hold on a second. I got another one popping up here. Let's see. Marcia has a suggestion for you, Kevin, on polling, and
Okay, I see that. Thank you, Marcia.
Yeah. And Sophia was asking, were they created in Excel or some other tool?
Actually, I had AI create them.
Okay.
We're just going we're going AI everywhere.
There you go. All right. Very good.
I sounds like Armida, you may have to do that as an education segment for us sometime soon.
Yeah, that's
So
pretty cool.
anyway, well, we've gone pretty long. Let's keep here. Let me do this. Let me get to the end. Oh, let me see. Why can't I? All right. All right. So if you have any questions, here's so you can reach us. I'm on slide 104. Hopefully everyone can see that.
Yep.
So there are the places to be able to get us at the Maryland chapter or the DC chapter or here at Digging into BI. And there's a picture of a bunch of us that were at BINC in 2024, and many of us will be back at BINC 2026 in Chicago in April. Hopefully you will join us. You can also join our mailing list here. You don't have to be a member of BI or in the DC regional chapter to do it. You'll get the notices for this. Kent, you want to tell us about volunteering?
Get on it. Okay, so as Kevin and Cheryl have mentioned several times, we are just a group of volunteers, and so we are learning and improving our skills as the time goes on, and we keep learning stuff from your questions and from your suggestions. So if you would like to learn and improve your investing skills and your presentation skills, please consider volunteering for your local chapter, whether it's Maryland, DC, Ohio, Illinois, Alabama, wherever you happen to be logging in from. And as a chapter volunteer, you can, in addition to getting new skills and new education and learning a whole lot, you can also benefit by getting some discounted rates on attending BINC or other chapter educational events, as well as getting complimentary subscriptions to the tools that you see being used during these presentations. So next slide, please.
So here's what's coming up in January. One of our new presenters, Bob Hool, is in the audience. He's actually going to be doing T-Mobile. And then we also have the stock to study and undervalued feature of Taiwan Semiconductor and Campbell's, the soup company. We still need one more idea. We are looking for people to help do presentations. We may have to break out and get non-Maryland, DC, and Virginia folks because I'm getting too many people looking at their shoes when I ask them to help out. So regular attendees, don't be surprised when I start asking you to do presentations. So we'll work around your schedule because we want to keep this going. Again, we had a really, really nice turnout here today. Thank you very much. We're going into our 5th year now. Boy, it's hard to imagine that. But here's where they are. Dashboard are up there. You can see these locations. You don't have to have a subscription to Manifest to see them. They're nice, good tracking portfolios. And then also you'll see the webinars will be up on YouTube. So that's what we have for you. But we look forward to seeing you next month. Now, we are going to be on the second Monday in January. So that will certainly free people up. There was someone who just was like, I can't make the first Monday of the month. Don't worry. We have the second Monday of the month in January for the holidays. So we can certainly use you then. Anyway, thank you very much for being here. We appreciate you staying with us. It went rather long, but have a great night.
Kevin?
Yes.
Yeah, Maskey said he would do it in January.
Okay. Very good.
And now you need some people for February.
Exactly. I saw Maskey was in the audience. Thank you, Maskey.
So Kevin, do you have a druthers on which company I present in January?
You get either the stock to study or undervalued feature. Do you like Taiwan or do you like Campbell's soup?
Taiwan Semiconductor. I'll take that one.
Oh man, you don't want to do Campbell's soup?
Yeah. You thought, yeah, no. I am just gonna leave it at that. So.
Right?
Good.
Armita's laugh. She doesn't even need to have her microphone on, and we can still hear that cackle.
Well, I know, it's a company I know she's really excited about. I can tell that from her laughter.
I may have to. I may be like the parent that has to eat the lima beans and peas all the time. These last couple
could be.
undervalued features have been pretty yeesh.
Yeah.
I try to give them the benefit of the doubt, but these last ones, it's just like, I don't know what they're smoking. So
Yeah.
anyway, we're getting pretty close here. I'm going to just shut this off. But again, thank you all for being here. And we will see you next month. Enjoy your holidays.
You do the same. Hopefully, see you in a couple weeks.
Exactly.
All right.
Take care. Talk to y'all later.
Night.
Good night.
All right.